Isn't it hard to figure out whether a stock is good value or not? Sometimes you look at the stock price, you look at the financial ratios, but it's still not easy. I'm going to show you how to figure out a stock price using a discounted cash flow model. And we're going to also look at the ratios of the stock at the end and compare them to its competitors. So we're going to look at Darden restaurants, and they own many restaurants: Olive Garden, Longhorn Steakhouse. So first thing we're going to need is the market cap. That's $9.1 billion. That's the value of the company according to the stock market. The stock price is 70.27. That's what they trade at. So to figure out the shares outstanding, you take the market cap divided by the stock price. You get 130 million shares outstanding. Next, we need free cash flow, and that's the cash that's remaining after operating a business minus capital expenditures. And this is how you value a company. You estimate the future free cash flows of the company, then you discount that number back to today's value. And that's what we're doing in this video. We also need net income, and that's the profit and loss on the income statement. And we take 4 years of that information. We also need revenue, which is the sales for the company. You want to take a look at the numbers. Make sure they look fairly consistent and they're positive. Because if either of those were not the case, it would be really hard to value the company. And they look pretty consistent. And when you do a discounted cash flow model, the inputs are so important. Because if you have really variable inputs, like for instance, if cash flow goes from 10 billion down to 1 billion, up to 20 billion, you could have really crazy results. So you want to have pretty consistent numbers, and these look pretty good. And they're actually growing each year, at least revenue is. So that's a good sign. Let's see the capital structure. We need to know their discount rate to apply to the future cash flows. So they pay $54 million in interest on their debt. Let's see how much debt they have. We'll go to the balance sheet for that. Short-term debt is due within 12 months and long-term debt is due after 12 months. Interest on debt is tax deductible, so let's get their effective tax rate. Let's take the 2017 number. And they have $637 million of income before tax and $154 million of taxes. So their cost of debt is 3.24%. And now let's get their cost of equity. We need the beta for that. The beta is the volatility of the stock. 1.34 is the beta. That means the stock moves a little more than the market moves. So the cost of equity is 12.6%. Let's get their current assets. We'll go back to the balance sheet for that. And current assets are cash, accounts receivables, and inventory. And they have $900 million of current assets. And current liabilities are liabilities that are due within 12 months. And that's $1.5 billion. And let's get their equity. That's the total assets minus total liabilities, and that's $2.4 billion. And we need their EBIT. That's earnings before interest and taxes, or operating income. That's $851 million. So they have 35% of debt in their capital structure, 65% of equity. So to get the weighted average cost of capital, it's a blend of cost of debt, 3.2%, cost of equity, 12.6%. That comes out to 9.4%, the WACC, and that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. Then we discounted those numbers back to today's value. And then we come up with the value of the company of $9 billion. We divide that by 130 million shares, and we get an intrinsic stock price of $67. They're trading at $70, so trading at a 4% premium. So it's a sell according to the model, but it's really close to trading at intrinsic value. And you can see it was trading at a much steeper premium a few months ago, but it's dropped a lot since coronavirus hit. It's come back a little since Corona. Let's see what Simply Wall Street values the company at. So they value the company at $57. I value them at $67. So we're both valuing the company at a sell. Mine is a lot closer though, so their model appears to be more aggressive for this company at least. Let's take a look at their financial ratios. So they're a pretty good PE. It's under 15. That's what I like to see. And the average PE is 26 in the market, and the median PE is 16. Their price of sales is really good. That's 1. That's price of stock over sales per share. And the average in the market is 4.3 and the median is 2. Pretty good price to book, 3.8. That's about the average in the market. They have a low current ratio of 0.6. So that means their current assets are less than their current liabilities, which is not a good sign. That means they may need to take on more debt in order to cover their current payables. But this could be a short-term problem. They have a good ROE, 27%. The median ROE is 15%. They have an interest coverage ratio of 16, so they could cover their interest payment to $54 million 16 times. That's a good sign. Debt of 35%, so they're definitely lower than the average. They have a 5% chance of default within the next 12 months. And the best way to look at ratios is to compare them to the competitors, because that's how you really know. And you don't want to compare ratios to the entire market, because different industries have different ratios. Some industries have naturally high PEs, while some industries have naturally low PEs. So these 7 companies are in the same industry as Darden: Starbucks, Dave & Buster's, Denny's, Cheesecake Factory. So Denny's has the best PE of 5.1. Darden is 14.3. The average for this industry is 24. So Darden is less than the average. The average price to sales ratio is 2.1. Darden is 1.0. The average price to book is 2.0. Darden is higher than the average of 3.8. Cheesecake Factory has the best of 1.6. Darden's ROE is 27%, which is a lot higher than the average of 2%, just because there's a couple of companies that are really dragging down the average. Negative 85% for Denny's and negative 58% for Starbucks, because they have negative equity. That means their liabilities are more than their assets. The average debt is 61%. Darden is doing well in debt. You see a company like Denny's with great ratios, look at the debt. If they have really high debt, that could be the reason they have good ratios. You generally want a company with good ratios and low debt or relatively low debt. And the market cap, Darden is less than the average. They have 9.1 billion. Starbucks, of course, is the biggest. So Darden has pretty good ratios. They're priced at intrinsic, so it's kind of a judgment call. What do you think? Do you think they're a good buy now or not? Let me know in the comments. Thanks for watching.